Hey everyone, Daniel here and welcome back to another video. Here today, I want to give you guys some clarity as to exactly what is happening in the stock market at this moment in time. Because if you open up any of your trading platforms, your brokerage accounts, the Nasdaq is down 2.26%. The S&P 500 is down 1.72%. The Dow Jones is down 1.4%. These are the indexes. Individual stocks are down much more than this. A company like Lemonade, which just reported earnings yesterday, is now down upwards of 16% on an earnings miss. Now, when we talk about exactly what's happening in the stock market at this moment in time, this morning we had CPI data reported. And if you've watched my video, I think it was a video on what Janet Yellen said, I mentioned that CPI data is going to be coming out within the next month or two, and that this is a date to watch, specifically today. Why? Because month-over-month comparisons of inflation are going to be ugly. And that is just the flat-out truth, and that is exactly what we got. Inflation came in at 4.2% year over year. But the thing is, when you compare year-over-year data, it looks uglier than it really is. But, there's no doubt in my mind that 4.2% is pretty dang bad. And we are still historically high when it comes to CPI data. But I just want to show you guys right off the bat. If we compare April, May of 2020, we were in a significant divot due to the fact that everything was shut down, velocity of money was cut off, unemployment was at all-time highs, causing inflation to essentially decrease substantially from the prior levels. Now what we have is an economy that's starting to reopen. Obviously, unemployment is still at pretty substantial levels. We got that job report a couple days ago that wasn't as good as expected. I think it was like 250,000 added jobs versus the expected 1 million jobs. In this situation, we're comparing essentially CPI data from April of 2020, when everything was down the toilet, to now, which is obviously a much better situation. And that is why we're seeing this massive increase when it comes to this difference year over year. And in my opinion, we're most likely going to continue to see these high levels, at least for the next couple of months. You'll see that May was also a pretty bad month. So once, a month away, once June comes, we're going to be looking at May data. That's also going to be pretty dang ugly. Obviously June, July, August, that, in my opinion, is when things will start to slow down. That is my personal opinion. And that is when we might potentially, again, this is all potential, potentially see some sort of recovery in the stock market. Obviously, at this moment in time, it feels like everything is decreasing on a daily basis, 5 to 10%. Companies that are trading at richer multiples are getting absolutely crushed for no fundamental reason except the fear of inflation. The market is baking in essentially the fear and the situation that inflation will come and inflation will sustain. Now, what we have, currently, I'm just going to pull up the 10-year yield here just to take a look at this, is obviously the market pricing this in, causing stocks to sell out, and essentially preparing for a situation where we see continued inflation for potentially the remainder of the year and going in over the next couple of years. Obviously, we have someone like a Jerome Powell saying that inflation, again, may be bad year over year, but generally speaking, once we get back on our feet, it'll be significantly better than it is today. And here I have the Treasury yield here. This is the 10-year yield. It's what we use to essentially kind of gauge what the interest rate is at the government at this moment in time. Currently sitting at 1.7%. It obviously spiked in a massive, massive way based on the data that we got, obviously with the 4.2% year over year inflation when it comes to CPI data. That's why we got this spike. And obviously, although this correlation between the 10-year yield and the stock market has been dissipating slowly, it is evident that it is still there on these violent moves. So on a day when the 10-year Treasury yield moves up from maybe 1.6% to 1.7%, you best know that stocks are probably going to be red. Now, going forwards, I still think that the 10-year Treasury yield is historically low. If we look at it over the past 5 years, we'll see that throughout 2017, 2018, 2019, we were trading, or not trading, but the 10-year yield, the bond yield, stood at over 2%, under 3%. So to get back to historical averages, we still have a ways to go. And, it's not the perfect situation, right? Because we see this going up and stocks going down. So does this mean that potentially, as this continues to rise, stocks continue to fall? Potentially. But in my opinion, this pain that we're feeling is something that might persist throughout the next couple of months, but into the fall, potentially into August, I think that's when things start to rebound and we get a lot more clarity when it comes to inflation, because right now everyone is freaking out over this comparison of year over year to March, April, and May. But going into the summer, we'll start to get a bit of recovery here baked into 2020, which will make these year over year comparisons a lot better. And even if inflation does end up coming, we're going to get a situation where a lot of it's actually priced in. Obviously, right now, the market is pricing in a potential situation where inflation does come and does persist throughout the remainder of the year and into 2021. So the more the market prices in, the better the worst case scenario gets, right? Because obviously, currently, if we get 10% inflation, holy smokes, the market's dropping massively. But if we end up potentially getting that inflation, potentially in the back half of this year, we'll have a situation where, all right, the market's already priced this in, and we probably won't have much lower to go. Now, what this also means, this whole situation with the Fed and whatnot, this kind of number that we got here today was above predictions, was above economist estimates. I think economists were estimating a little over 3%, and it actually beat pretty substantially over 4% year over year. So the question is, will this inflation continue throughout the remainder of the year and into 2022? Potentially, right? And I think this is one of the decisions that the Fed is going to have to make. All eyes are going to be on the Fed whenever they do their next press conference to, get a good understanding of what their thoughts are now on inflation compared to what it was before. Obviously, now we got a lot more data. We got, 4.2% year over year comparison, although that might be a little bit, kind of put onto a pedestal, to say the least, is historically high, right? So we'll see what Jerome Powell ends up saying on this. We'll see if he ends up shifting his narrative. It does look like inflation is a little bit higher than expected, but going forwards, I think the market is really pricing this in. So anyways, guys, thank you so much for watching this video. If you appreciate these updates, please consider subscribing, and see you all next time.